Today, homing in on housing price falls. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Just before we start, a quick reminder that tonight at 8 p.m. Sydney time, I'll be discussing money and derivatives. And this will be an interesting conversation because we're trying to understand the relationship between the underlying value of money and all of the myriad types of derivatives, including options, that actually are out there and how they potentially influence the market, what's happening to regulation, and what may happen ahead. And we'll also be making some observations around the relationship between Bitcoin and the various derivatives of crypto that exist, because this actually does change the game once you actually understand what's going on. So join us at 8 p.m. Sydney time. You can ask a question live. New data highlights the housing affordability issues across Australia, and another major bank has come out with a forecast fall in home prices ahead. So things in property are getting interest. And I'm also now waiting for the next government response. How about yet more first-time buyer bribes or financial support direct to developers? With an election in the wind, the government will want to find some way to prop the markets up for the next few months before a later collapse. So expect more unnatural acts ahead. Well, unnatural from an economic and social perspective, but unfortunately totally logical from a win at all cost, never mind the price attitude that we've seen from this government. Well, the White House announced today that President Biden will re-nominate Republican Jerome Powell for a second term as chair of the Federal Reserve's Board of Governors, but will also elevate Democrat Lael Brainard to vice chair. Powell is opposed by some prominent Senate Democrats, but supported by many Republicans, and Brainard doesn't seem to face opposition from Democrats. Both will likely win Senate confirmation. As you'd expect, of course, both Powell and Brainard released thank you statements about their nominations. But there was something that you might not expect. Suddenly, fighting inflation has become the number one priority in both of their statements, after they'd driven inflation to a 3-decade high through record gigantic money printing and interest rate repression, and then had stubbornly brushed off this inflation as something that would quickly go away on its own. There wasn't a single word in their statements about inflation being transitory or temporary, and about the Fed needing to be patient and waiting on it for it to go away on its own. But inflation was suddenly a real problem that needed to be dealt with. Powell's first priority is now to, quote, prevent higher inflation from becoming entrenched, he said. The unprecedented reopening of the economy, along with continuing effects of the pandemic, led to supply-demand imbalances, bottlenecks, and a burst of inflation. We know that high inflation takes a toll on families, especially those less able to meet the high costs of essentials like food, housing, and transportation. We will use our tools both to support the economy and a strong labour market and to prevent higher inflation from becoming entrenched, he wrote in his statement. Now, this is extremely significant insofar that does signal higher rates ahead sooner than many expected, and indeed the bond markets reacted accordingly. Which just brings us straight back to Australia, and the question as to whether the Reserve Bank here will be able to stubbornly keep rates ultra low. Personally, I think that's highly unlikely, and as a result, I do expect to see rates rising quicker, and that's going to put more downward pressure on house prices than many expect. And just remember this, people are highly leveraged, and whilst interest rates are ultra low, they may be able to manage their mortgage repayments. The question, of course, comes, what happens when rates do go higher? And that feedback loop, thanks to financial repression, is something that many economists still have failed to understand in the Australian context. We are in for a very interesting couple of years, I think, and I suspect the downward momentum on house prices will be stronger than many expect. But of course, as I said earlier, there is also an election ahead, and so that is going to also cool the pitch for a few months. After all, no government will want to go to an election against falling house prices. ScoMo's already up against it. That's one extra battle he doesn't want to have to fight. So first, national housing affordability took a great slide in the 3 months to August, with an index recording a 15.6% annual fall. Bluestone Home Loans released its Home Loan Affordability Index for September, which has shown the declining housing affordability is accelerating. The index measures the proportion of the average income required for the average home loan repayment and is derived from the ABS data, with higher index numbers reflecting a higher proportion of the average income required. Housing affordability, as denoted by Bluestone, is reflected in higher index values. The latest index for the September quarter showed a 1% decline in national affordability during the August quarter, compared to a 0.8% decrease in the previous 3 months. In the September quarter, the index climbed to 91.76, up from 90.8 in the August quarter and above the long-term average for 4 consecutive quarters of 86.9. Over the 12 months to August, national home loan affordability fell by 15.6% as a result of booming house prices, sharply increasing the average loan size required by buyers. Andrew Wilson, consultant economist at Bluestone Home Loans, commented, "As the index has risen, the number of loans approved has begun to fall. Recent strong house price growth has resulted in buyers having to borrow more, and with subdued wages growth and flat interest rates, this has resulted in a higher proportion of incomes required for loan repayments," he said. Stricter lending conditions from financial institutions also place a ceiling on borrowing capacity for buyers, which results in reduced demand and lower prices growth. New South Wales and Victoria had recorded the steepest falls in home loan affordability, with annual declines of 20.6% and 17.4% respectively, reflecting recent sharp house price growth in Sydney and Melbourne. Affordability has slipped across all states during the quarter, with the exception of the ACT, which saw a rise of 1.1%. The Northern Territory faced the largest quarterly change, a 2.5% fall in affordability, contributing to an annual fall of 4.5%. Tasmania was down 1.7%, South Australia was down 1.4%, and Queensland was down 1%, while Western Australia dipped by 0.3%. New South Wales was also the leading state for relative unaffordability, 27.1% higher than the national result over the September quarter. Victoria, on the other hand, was 5% above the average, with all other states falling below. The NT fell to the bottom of the list, being 30.6% lower than the average. Western Australia was down 30.1%, South Australia was down 20.4%, Tasmania was down 19%, Queensland was down 12%, and the ACT down 10.2%. The results have come as the House of Representatives Committee on Tax and Revenue has continued its inquiry into housing affordability. During hearings last week, researchers added to calls for the government to set a national housing agenda and to assign a minister for housing. Reserve Bank of Australia Assistant Governor Lucy Ellis acknowledged that maintaining the cash rate at record lows had pushed up house prices by allowing consumers to service a larger mortgage on the same income. But she stated the alternative, a higher cash rate, would have resulted in higher inflation than offshore peers and economic instability. At the same time, ANZ and CBA have tipped that surges in house prices are set to see some level of reversal in 2023, with ANZ projecting a 4% fall following a 6% rise across capital cities in 2022. And looking at what CBA said in more detail, they say the Australian housing market is in the twilight of an incredible boom that has been fueled by record low mortgage rates. The phenomenal lift in prices is not yet over, given dwelling prices are still rising briskly in most capital cities. But near-term indicators of momentum, coupled with the recent move higher in fixed mortgage rates, suggest that conditions will moderate from here. In many respects, it's a simple story. The price that someone is willing and able to pay for a home is predominantly influenced by two things: income and borrowing rates. As home prices move higher, affordability becomes stretched. That can be improved via a reduction in mortgage rates or higher income, but at some point, the tailwind of lower mortgage rates on prices wanes unless there are further cuts in interest rates. Of course, the story is not all one way. Interest rates become a headwind on property prices if they're rising. That is the place we believe we are moving towards over the next 2 years, given our expectations for the RBA to commence normalising the cash rate in 2022, they said. So they updated their central scenario for house prices and extended their forecast profile to the end of 2023. Dwelling prices nationally will end 2021 up by around 22%, and very much in line with their call of 20% in early August. From there, they expect prices to continue to rise through the first half of 2022, but at a more modest pace. And they look for prices to peak in late 2022 at around 7% higher than the end of 21, and then they expect an orderly correction to dwelling prices of 10% in 2023. A gradual and shallow RBA tightening cycle that takes the cash rate to 1.25% by the third quarter of 2023 lies at the heart of their expectations that home prices will contract over 2023. The cash rate is forecast to lift because the economy will be at full employment and annual wages growth will have pushed to the desired level of 3%. Stronger wages growth will provide a partial offset to rising interest rates on the property market, and in addition, a lift in population growth as the international border reopens will boost the underlying demand for bricks and mortar, particularly in the city apartments. As such, they expect house prices to decline by a little more than apartment prices over 2023. Lockdowns in large parts of the country from July to October 21 had no discernible impact on the demand for housing. The upshot is that housing in Australia has risen at an extraordinary pace over 2021. According to CoreLogic, property prices rose by a robust 1.4% across the 8 capital cities in October. That builds on similar increases from July to September, although there has been a clear moderation in the monthly pace of price gains. Annual growth accelerated to 20.8% in October due to base effects. The housing market has without a doubt been red hot, but the recent price outcomes predate two key developments that will exert a cooling influence on the property market. First, APRA announced in early October an increase in the minimum interest rate buffer it expects banks to use when assessing the serviceability of home loan applications. More specifically, the minimum interest rate buffer was increased to 3% from 2.5%. The policy change came into effect on the 1st of November. Second, a number of lenders have in recent weeks lifted interest rates on fixed rate mortgages in line with higher funding costs and the RBA's abandonment of its yield curve target. This will have a dampening impact on the demand for credit. The share of new lending that has been fixed over the pandemic as opposed to floating has been a lot larger than usual because fixed rates have generally been lower than the standard variable rate. This increase, therefore, in the interest rates on fixed rate mortgages will have a larger than usual cooling influence on the demand for credit. And in addition, the lift in the fixed rate is a reminder to would-be borrowers that interest rates can move higher. They believe that APRA will welcome a lift in fixed rates to the extent that it makes it less likely that they will need to employ further macroprudential policies to cool the market. Indeed, it is now their central scenario that the housing market will moderate sufficiently over the early part of 2022 and that there will be no further macroprudential policy changes. A cooling market is not the same thing as a falling market. Prices are still rising at a reasonable pace, they said, and near-term momentum indicators like auction clearance rates and house price expectations indexes, which feed into the proprietary modelling that they do, points to home prices continuing to rise at a softening pace, which now sits at around 1% a month. They expect the pace of monthly gains to moderate quite significantly by the middle of 2022, due primarily to higher fixed mortgage rates. As this happens, they expect a cooling feedback loop to intensify, whereby subduing buyer expectations, coupled with general fatigue and a growing anticipation of RBA rate hikes, sees prices peak in the third quarter of 22. At this point, they forecast prices will be about 7% higher from the end of 22 levels. While in some respects, point forecasts are false precision, they provide guidance on what sort of a lift in prices they're looking at for 2022 before the peak is reached, which they believe will be on the eve of the RBA's tightening cycle. The extent to which prices correct lower will depend in part, a large part actually, on the speed and magnitude to which the RBA lifts the cash rate. On that score, they expect a shallow and gradual tightening cycle given the elevated level of household debt. Their base case is that the RBA starts normalising the cash rate in November 2022, and they've penciled in the first increase of 15 basis points in November 2022, which will take the cash rate to 0.25%, and they expect that to be followed by an increase of 25 basis points in December 2022, and they have 3 further 25 basis point hikes in Q1 23, Q2 23, and Q3 23 that takes the cash rate to 1.25%. That's their estimate of the neutral rate, which is a lot lower than the RBA's estimate of at least 2.5%. The standard variable rate could be expected to move higher in a broadly similar fashion to the path of the cash rate As such, a lift in the cash rate to 1.25% would take mortgage repayments as a share of household disposable income to around 15%. This is a level we assess to be normal based on the experience of the past 2 decades. Rising rates will put downward pressure on the demand for credit, which will result in dwelling prices correcting lower. Indeed, rising rates work in much the same way. Falling interest rates generate an increase in demand for credit and higher home prices. The impact of rising interest rates will be quite significant on borrowing capacity and credit demand, given the percentage change will be large. The lower the starting interest rate, the bigger the percentage change for a given percentage point change in rates. However, it is important to consider why we expect the RBA to raise the cash rate in late 2022. The economy will be at full employment and annual wages growth will have pushed to the desired level of around 3%. Stronger wages growth, they say, will provide a partial offset to rising interest rates on the property market. In addition, a lift in population growth through 2023 due to higher net overseas immigration will boost the demand for bricks and mortar. As a result, they forecast dwelling prices will fall by around 10% in 2023. This may on the surface sound like a large fall, but context is key. Price rises have been exceptional over 21 and further gains are still forecast in 22. A decline in national dwelling prices of 10% in 2023 in their figuring simply takes prices back to where they were in the third quarter of 21. Of course, the decline will be larger in real terms. The backdrop from the economy running at full capacity, which is why the RBA will normalise the cash rate, means they believe the economy will be well positioned to absorb a decline in home prices of around 10% over a year, and it won't be the first time home prices have corrected lower. Recall that national home prices declined by 10% from September 2017 to June 2019. The key risk in their forecast for home prices, both upside and downside, is the path of interest rates. If the RBA tightens policy more aggressively and or earlier than their forecast profile for the cash rate, they would expect dwelling prices to fall by more than the central scenario. Equally, if the RBA tightens policy later than they anticipate or delivers a more shallow tightening cycle, they would expect a smaller decline in home prices in 2023. In the near term, the main risk to their forecast profile is around macroprudential policies. If APRA was to bring in additional policies to cool the housing market or further lift the serviceability buffers, they would expect smaller price rises in 2022. So 2 quick points. The first is, of course, that it shows absolutely that house prices are directly linked to credit availability and interest rates. The second is, of course, that CBA is trying to convince APRA not to move on its macroprudential. And of course, APRA doesn't want to, but it should, because, of course, we've built up huge debt pressure in the system. CBA is, in a way, therefore, talking its own book. And I do think that the Reserve Bank will probably have to react sooner on interest rates because of what's happening around the world. And it will be very hard for the Australian economy to continue with ultra-low interest rates if rates around the world and financial market rates continue to rise. I would not be surprised to see rates rising quicker here. Therefore, prices could drop more quickly. I'd also make the point that they do not differentiate sufficiently between units and houses. A lot of the price growth in recent times has been in the house sector, particularly standalone properties. Units are a very different story, and in some cases, units are already falling. They've been falling for quite some time. Unfortunately, these high-level forecasts are not very useful because they don't give you sufficient granularity to make sensible decisions. You need to go granular. And as I continue to say, the only way to understand what's going on in the property market is to look at individual areas, individual property types, and individual scenarios. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.